The average American carries more than $90,000 in debt. This adds up to more than $14 trillion in total consumer debt. But not everyone has $90,000 in debt. The amount of debt you have corresponds to different factors, including age. For instance, Americans in their 20s, 30s, and 40s are more likely to carry student loans and mortgage debt than retirees. Debt is risky because it comes with interest. When you fail to pay off credit cards or loan balances in full, the interest compounds. As a result, debt increases quickly, which makes it harder to pay off. If you don't practice responsible personal finance habits, the amount of debt you owe could become a serious burden. Knowing the average debt by age allows you to see how you stack up with others in your age range, providing a gauge so that you can determine how quickly you need to take action to improve your personal finances. The common types of debt include credit cards, mortgages, student loans, auto loans, personal loans, and so on. Here's the breakdown of the average amount of debt at every age in the United States. For ages 18 to 23 years old, the average debt is about $9,593. This age group is called Gen Z. Student loans are the primary source of debt for this age group, followed by credit card debt. Student debt has more than doubled over the last 2 decades. At the end of 2020, about 43 million US borrowers borrowed nearly $1.6 trillion altogether in federal student loans. Additional private loans bring the total to about $1.7 trillion, surpassing auto loans and credit card debt. Only home mortgage debt at about $10 trillion is larger. Many experts and policymakers argue that the surging student debt is harming younger generations of students by preventing them from reaching their financial goals while exacerbating racial inequality. While older generations were generally able to pay their way through school or find jobs that enable them to pay off their debts, that no longer holds true for recent graduates due to the soaring cost of higher education. For ages 24 to 39-year-old, the age group referred to as millennials, the average debt is about $78,000, most of which is credit card debt. Credit card debt is one of the worst type of debt to have. Credit cards often have high interest rates that can cause debt to snowball. Only 16% of those in this age group have student loan debt. Furthermore, only 3% have mortgage debt, and most of it is credit card debt. One of the reasons for this credit card debt is expenses. In this age group, expenses tend to increase drastically due to lifestyle changes such as children or pets. As a result, disposable income shrinks. When disposable income shrinks faster than salary increases, people take on debt. For ages 39 to 49-year-old, the average debt is $135,000. Primarily because of home mortgages, older millennials in this generation maintain a higher average debt, according to Experian. Some financial experts, like Kevin O'Leary, assert that you should be debt-free by the age of 45, which is considered middle age. He says that when you're 45 years old, the game is more than half over, and you better be out of debt because you're going to use the rest of the innings in the game to accumulate capital. It is a lofty goal, especially considering that it includes mortgage payments. But even if people aren't able to change their mortgage or car payment amounts, they can and they should cut down on their average credit card balances and the interest rate they carry. For ages 50 years or older, the age group referred to as baby boomers, the average debt is $96,000. Mortgages, credit card bills, and auto loans are the 3 main debt sources for this group. Although this is less than the average debt for those aged between 35 and 49, it could still spell trouble for 2 primary reasons. 1. Baby boomers are moving towards retirement. Carrying debt at this age could make retirement more challenging. Boomers will need to work longer than they had planned to improve their net worth and enjoy a comfortable retirement. Furthermore, older people must also factor in healthcare costs. Along with the cost of medication and doctor visits, an unexpected healthcare bill could increase debt. Unexpected healthcare incidents could arise at any time, but there is more risk as you get older. If you have debt, there's no need to panic. Many American households carry debt. With things like student loans, mortgages, car payments, and everyday expenses, taking on debt at some point in your life is inevitable. Make a list of what you owe. List all your debts with balances, due dates, interest rates, and minimum monthly payments. Go over your budget. Write down how much you earn every month and how much you need to spend on bills such as rent, utilities, groceries, and minimum debt payments. Find room for debt payments. Subtract your bills from your income to see what's left over. Put this amount towards your debt each month. You could also put windfalls such as tax refunds towards your principal balances. Prioritize the debts. Financial experts usually recommend using one of the two methods, the snowball method or the avalanche method. With the snowball method, you pay off your smallest balances first, then you move on to the largest one. With the avalanche method, you focus on paying off the balance with the highest interest rate first, and then you work your way down from there. Make a goal based on your debt balance and extra payments. How long will it take until you're debt free? For example, if you want to pay off $5,500 in credit card debt and you can pay $500 each month, then the balance should be gone by 12 months, assuming a 16% APR. With a bit of work, you can move towards financial freedom and debt-free living.